I'm thrilled to convene us today. And I'll just open with a quick reminder. These are public calls for those tied to the foundation, who are, in some cases, fund holders and organizations who have trusted us with their reserve or endowments. In some cases, potential prospects, folks exploring partnership with the foundation, and obviously a number of staff of the foundation and board members of the foundation as well. I'm excited for that. This is intended to be a dialogue, so encourage folks to ask questions. We've got, I'll turn it over to Nancy in a moment, and Mike Miller for the presentation from Crucial, but it's a really good opportunity. It's likely if you're thinking about a question, somebody else is thinking about it as well, so encourage folks to ask questions, because it helps us all expand our thinking about what we're witnessing in the world and the ways in which we can steward philanthropic resources to that end as we look forward. So thanks again. Thanks for your partnership in the Vermont Community Foundation and the work of making a difference in Vermont. I see Mike Miller here from Crucial. I am going to turn it over to Nancy Brock, the VCF's, the Vermont Community Foundation's new Vice President for Finance. Nancy started with us May 1st. I can't remember if this is her second public call, but I do reintroduce herself.
Great. Well, thanks, Dan. Can everybody hear me? Good, because I've had all kinds of technical difficulties today, so I'm thankful to be here. And it is my second public call. I think the first time I was really just trying to figure out how to get to work, and thankfully now we know how to do that, and have some, I think, better news from Mike coming up from the last month or so. Today's a little bit of a rough day, but some better news to talk about. And as Dan said, we hope this is interactive and that you share your thoughts, your questions and concerns, so that we can address them and understand better what you're thinking, what's on your mind. So thank you for joining us. And I think, Mike, you're going to take it from here.
Great. Thank you, Dan. Thanks, Nancy. And again, I apologize to everyone for being late. But I'm here now. And I'm going to bring this up. I hope everyone can see this okay. Give me a second to make it into a slideshow. That's working? Everyone can see that? Perfect. So it is good to be with everyone this afternoon. And I wanted to walk you through some of the investment results, talk about the portfolio, of course, the pools that the foundation offers, and also to maybe touch on, I'd like to touch on some of the differences between short-term and long-term anxiety. And I think it's an interesting time in so many regards from that perspective. So we'll cover some of those topics. And as Dan and Nancy suggested, it'd be great to have your questions along the way. Please don't hesitate to stop me at any moment. So here are the results. And we're going to spend a little time on talking about how we think about performance and how we think you should interpret performance. But to start with the bad news, which, as you can see in the very first column, the year-to-date losses were considerable at the end of June. And in the case of the long-term pool, a little bit behind the benchmark. In the SR pool, a little more behind the benchmark because it's got a bit more of a growth orientation. Although, as you can see, the SR pool has actually generated stronger absolute and relative returns out as far as 5 years. So each of these little groupings is one of the three pools: long-term pool, socially responsible pool, and the midterm pool. And the midterm pool, not surprisingly, has been the best performer. It's the lowest risk and the lowest amount of equity exposure, which is what you'd expect in terms of in a down year like this year, which we will talk about why the market's down as much as it is momentarily. The benchmarks, there's the custom market benchmark, which you can see is we try to mimic the asset allocation strategies of each of the pools with index funds. And you can see if we were looking back at the last 5 years, and these are net of investment management fees, but nevertheless, the long-term pool has fallen 0.8% short of its benchmark for the last 5 years. For 10 years, 15 years, and since we started with the foundation in 2002, the absolute returns are not satisfying. We like to think that an 8 is what makes us happy, not a 6 in terms of the first number, but we're going to get back to that, I can assure you, and I'll show you some of the numbers behind that in a minute. And the second thing is you can see, though, the big benchmark premiums of the past have not been repeated more recently. We will definitely talk about that today a little bit too. The SR pool, socially responsible pool, actually has a stronger record in terms of it's outperformed. It's been around the benchmark more recently, recently. And I think it's very important to note that when you look at numbers like these, you're looking at something that we call, it's a little deceptive. We call it endpoint sensitivity, which means if you have a bad endpoint, it can drag down your longer term numbers. So for example, if you look at the socially responsible pool, which is underperformed by 1.3% so far in 2022, you look at that number and you say, okay, I understand. Then you look across at the 5-year number and you say, well, you've underperformed for 5 years by 0.1%. And the reason we think it's a little deceptive is that number suggests, well, you haven't outperformed in 5 years, which if you look at this moment in time is true. But along the way, that 5 years, the portfolio actually outperformed most of the time. It's this last few months, frankly, that has dragged down the 5-year number, which is why I want to spend a little time today talking about how we think about performance. Because unfortunately, no matter how much we'd like to be consistent, we don't really know how to do that, because the reality is to be consistently beating an index means sometimes you have to do the dumb things the markets are doing. And we refuse to do that, as you might guess. We're more focused on long-term compounding capital at good rates of return. You also see at the top the CPI plus 5 return, which is an enormously large number. It's been very hard to keep up with. Calendar year to date, it's up 8%. I remind you that's only 6 months though, so you're hearing higher numbers from in terms of consumer prices in 2022 so far. But a lot of the times when you hear media reports and other reports, even from the Bureau of Labor Statistics itself, they're quoting annual numbers. And so this is just still 6 months. And so you can't double that number, just to be clear. But with that said, you can see some really high returns coming from CPI plus 5%, which we use just as a proxy for long-term purchasing power preservation. So I'm going to move to the next slide because this is a little bit, again, I forgot one thing Nancy actually told me. She set me up perfectly and I forgot to say it. July and August, even with today, have actually been better for the portfolios, as you might guess. So I can't do through today. We don't have a real-time pricing, but we did do through Friday. So we'll have to just accept that as the best we can do. The long-term pool is actually now down 9.9% year to date. And the SR pool is down 10.4%. So those numbers have gotten quite a bit better. They're still nowhere near what we'd like them to be, but needless to say, we're pleased to see some recovery going on. And obviously, next time I see you, we'll have another data point in terms of the recovery, and then the time after that, and the time after that. But I will tell you this: just like every other crisis we've been through collectively, in terms of markets at least, we've come out the other side, and this time will be no different. Just to be clear. So on that theme, perspective is really interesting and important. We've only done this for the long-term pool, not the socially responsible pool, mainly because we have just a longer track record to show you here. And over time, the socially responsible pool has a good track record. And we're going to start showing it to you as it gets well past the 15-year point. But what this graph is doing is it's taking the exact same numbers we looked at a minute ago, and instead of looking at them per year, it's compounding them. What are the cumulative returns, which ultimately is the power of time and positive returns. And a couple of things really jump out off the page at you. The first is the 1-year number, which again, very disappointing to be down 15%, but that 1-year number actually doesn't look like quite as big a deal as it did here, where it just sort of jumps off at that big giant negative number. And then you look at it here and say, well, okay, in the context of 89% gains, which includes the 15% loss, of course, for 10 years, 19% gains for 15 years, and 260% gains since 2002, it doesn't feel quite as significant. And that actually is the right way to think about it, too. It's really important that we keep this perspective in terms of what we're really focused on here, which is the long-term outcomes. The second thing, just to go back for a second, I'm sorry for the back and forth. Hope I'm not making anyone dizzy. But when you look at, for example, the 15-year number, 5.4 versus 4.2, it sounds pretty good. 6.7 versus 5.5, sounds pretty good. But this really tells the story much more, which is those relatively small premiums multiplied out by a decade plus of time creates gigantic premiums. And so 118 again versus 85, 260 versus 186. So these are the same numbers, just compounded out and cumulative over time. And this is why, while I frankly am embarrassed when we don't outperform, particularly over a 5-year period like you see here, if the trade-off is, well, sometimes we have to look a little subpar for 3 or 4 or 5 years in exchange for this outcome, I'm personally willing to make that trade-off, and the investment committee and Dan so far have been as well. And I think that's how we think about these things, because we're doing something which is important, which is we are positioning, and always are positioning the portfolio for what we think is coming next. And sometimes we're a little bit off base on what that looks like. And I'm talking about basically not big macro picture, but just where the market should go. And the second thing is we're sometimes and frequently effective, not sometimes, we're always early. We get there when opportunities look really good on a long-term basis, and it just takes other people longer to figure it out whenever they do or don't do that. So this is something else we think about a lot, which is long-term versus short-term, which leads to, I'm sorry, very complicated tables, but I want to walk you through the last part of how we think about performance, which is there really are two major factors that we are concerned with. Well, three. The first is long-term outperformance, like you saw a minute ago. That's the first thing we care about. But then the second thing we care about is consistency, even though we can't be completely consistent, and what we call skew. And the skew is all about what we would argue is the execution of this strategy in a skillful way. Because at the end of the day, as you all have seen, I'm sure, in lots of portfolios with lots of managers, people have good days and they have bad days. And if they just cancel each other out, which is frequently what happens in the real world, that is not a positive outcome. That's a waste of time, a waste of fee dollars, and just a waste of energy in general. So we have these 4 lines. I'll start with the long-term pool, and then we'll talk about the socially responsible pool as well. So batting average, what does that mean? It means looking at every single rolling 3-year period from 2002 to June 30th of 2022, what percentage of the time did the portfolio outperform its benchmark? So I showed you before, go back for a second, the portfolio for 3 years and 5 years is not outperforming its benchmark at this endpoint. But this graph and table looks at every endpoint using monthly data because we have monthly information on the portfolio. So it's a lot of months. And what this helps with is some perspective on the consistency or lack thereof of performance. And in this case, we're pretty pleased. Basically, 85% of the 3-year period. So if you look at every single report we've issued from 3 years past 2002 till today, 85% of the time the portfolio outperformed its benchmark. 89% if you look at the 5-year periods that are rolling forward, 94% of rounding up for 7 years. And actually the portfolio has never underperformed for a 10-year period. That's why it says 100% batting average for the 10-year period. The second line, median outcome, and these are the cumulative numbers again, but looking at every single period of time, either whether it be 3 years, 5 years, 7 years, or 10 years, what was the median? And so for those who don't do statistics all day, the median is the middle of the distribution. Half of the times the outcome was better, half the times the outcome was worse. So here you can also see something that we put a lot of weight on, which I tried to show you a minute ago, which is these are big levels of outperformance. These are not per year, they're cumulative. So it's going to be a little bit of the math doesn't really work this way. But if you think about the median outperformance being 31.2%, that's actually translates into about 2 to 2.5% per year of outperformance over the index. And that creates a sizable gain relative to the index, as you can see, which is one of the reasons we think it's worth it to take on the risk of falling short over shorter periods of time. And then last but not least, best outcome and worst outcome, literally just take what you guessed, the best outcome and the worst outcome of every one of these data points. And here again, we're not happy, obviously, to be 7% behind the index. That's cumulative again, not per year, or 5% over 5 years, or even 3% over 7 years. But look at the skew. So when things go well, they go much stronger, outcomes than when things go badly. And to us, that's a sign of the skill that the committee and Dan and we've brought to the table over the years, which is to actually have better outcomes than our worst outcomes. So you put this all together, the way we think about it is that we like to think that the 3, 5, 7, 10-year numbers will be 75% plus success rates. And then obviously higher as you go out the longer periods. Of our whole point is we're doing the right things. It takes longer for them to work. You'd expect the longer term performance numbers to be higher, which is what you see here. And then that positive skew. Now we'll do the same thing for the socially responsible pool, which was shifted in 2010 to what we call the modern strategy, or a version of the modern strategy, which is more diversified. And here you can see it's kind of interesting. The numbers are a little more mixed. 72% for 3 years, which again, a little bit below our bar. We're really thinking 75 is our number. So we're in the neighborhood, but not quite there. 5 years and 7 years and 10 years are well into that realm. You can also see that the outcomes aren't quite as strong, and I'll talk about that in a second. In terms of the median is not as high. And then the best outcomes and the worst outcomes, generally speaking, the skew is good, with the exception of 3 years, where it's actually not good, but mostly it's good. So why is this different? It's not different because socially responsible investing, or the pool itself, is inferior in some way. It's different because of two things. So first of all, we only have 12 years of data, so there's less data points here. Let's be clear. When you have 2002 to 22, you get a lot more data points. Plus, you get to pick up that amazing period, which, by the way, we're back in again right now, from 2002, where these incredible opportunities have been built out of some of the excesses of the late 90s. 90s. So the socially responsible is missing that. It's also missing the opportunities that were created in the '08 crisis as well. So it's a little unfair to the pool, is what I'm trying to say. And the second thing is the socially responsible pool, for now at least, although not forever, has a much heavier index exposure. And so if you own your own benchmark, you can't outperform it by as much, nor can you underperform it by as much. And we're seeing some of the benefits of that more recently, where the pool's actually done better than the long-term pool. And that's part of the reason for it, but not the only reason for it. Socially responsible pool looking forward, I just want to be clear, is a really, really interesting pool. They're both interesting pools. And I would expect, and you should expect, to see these numbers hopefully not converge in the way that the long-term comes down to meet the socially responsible, the other way around, where the socially responsible pool begins to pick up ground. And we will update this for you, not every quarter, because it's not worth looking at quarterly, but we will update it for you periodically, show you the trends, so you can see that what I'm thinking is happening or starting to already happen will continue. So let me take a quick pause. I know that was a lot to digest. I apologize for the numbers. I think some of you might know I did my master's degree in statistics, and so I think this is awesome. I'm not sure everybody always agrees with that kind of stuff, but there you go. Are there any questions so far? Okay. Oh, was there a question?
No, I just took off mute to double check, and I don't see anything in the chat. So
okay.
Feel free to raise your hand or drop something in the chat if you do have a question.
Thanks, Dan. Okay, so let's go back to the philosophy as a reminder about how we do things. So let me tell you what we're not doing. The investment committee is going to be meeting in about 45 minutes. And no matter how much everybody would like to know whether we're going to have a recession this year or where interest rates are going to end up or how a million other things that really do matter, by the way, they're not insignificant in our lives, we're not going to spend any time on those things, I don't think, mainly because we just don't know what's going to happen. And we have no edge. And I think when you go back and look at a 20-year record of success, 100% of the time beating your 10-year benchmark and very high hit rates otherwise, the only way you can actually do that is not to try to do things that you just don't have a very good chance of being successful at. So we spend a lot of our time thinking about what are the things that the Vermont Community Foundation can do that are repeatable. And no offense to the committee or anyone else, but if we're going to rely on acts of genius, that's not a repeatable strategy. I'm sorry to say, that just comes and goes. So 3 things that as we listed here. First is we think very long term. It's frustrating in the short term when you don't like the outcomes. But with that said, we maintain that discipline, and the committee is amazing. Dan is amazing. And so we just, I don't worry about anyone losing patience with being long term, whether we're doing things the right way or not. It's a different question, of course. And the second very closely related point is we're not going to, as I just mentioned, we're not going to figure out what the markets are doing this year. I actually rightfully so, have lots of clients who say to me, hey, doing the budget for next year, where do you think our returns are going to end up this year? And, I know my answer can't be, I have no idea. I mean, that's why I tell them, of course, I have no idea, because we don't. But, we make a guess. But I always feel stupid because I'm like, why is my guess? You might as well just go ask, any random person in the park what they think too, because I have no better information than anybody else has in terms of what the markets are going to do this year. And thankfully, I hope you'll be glad to hear, the Vermont Community Foundation's strategy is not built on that. We built it on some things that are, I think, a little more solid, a little more repeatable. So I'll talk about it in a minute. And the last thing, and this is the beauty of having these, multi-$100 million plus pools, $100 million plus pools, is that we can be very diversified here. We can do a lot of things that smaller portfolios cannot do. And these are the things that have created a lot of success over the years. We don't know when this success is just going to show up, but it does. And when it does, it makes things work very, very well. And it happens in relatively gradual increments, which is really important. So here are the strategic mixes of the 3 pools. The committee reviews these annually. They don't change them annually. A long-term thinker doesn't generally change their asset mix very often. They change it in reaction to a couple things. One is, sometimes the risk tolerance can change a little of a pool. That hasn't really happened here very much. The second thing is markets change. So if interest rates tomorrow were 6% on the 10-year Treasury, that would probably lead to a different asset allocation strategy than you see here. If the stock market falls 40%, that would also probably lead to a different strategy than you see here. There's a whole bunch of different things that drive this, but they're basically slow-moving reactions to markets, which generally speaking are not that unstable, despite what you're seeing today. So as you look at the 2 first pools, which are the more long-term oriented pools, the long-term pool and the socially responsible pool, you'll see they both have very significant public equity exposure. Just as a reminder, special opportunities, these are equity strategies. They tend to be a little more nuanced and focused, things like life science investing and that kind of thing, which have been, really, really very volatile this year, very good recently, but normally quite volatile. So that is what that is. So those are all equities, just to be clear. You can also see that because the long-term pool owns some hedge funds, it has a little bit less in fixed income than the socially responsible pool has. And then you can also see they both have private asset exposures, which have been very interesting and successful in our opinion, especially in the long-term pool. The socially responsible pool has made some investments that we think are going to be incredibly good. One of them's already shaping up to be really strong, but it's a little younger in terms of its exposure to that area. So the numbers aren't quite the same in terms of the impact that area has had. The midterm pool, as just a reminder, is built for a medium-term philanthropic time horizon. So think 3, 4, 5, 6, 7 years, something in that neighborhood. So what we've tried to do here is we've basically tried to keep this more balanced. A lot of bonds, similar amount of stocks to the bonds, actually exactly the same amount. And then all three pools, and that again makes the pool less volatile. It's also a lower returning pool over time, which is what you'd expect. Risk and return, volatility and return should be correlated to one another. And all three pools have 5% of their portfolios allocated to the Vermont investments, which I know you guys know a lot about, which has been a wonderful part of the Community Foundation's history and investing. Let me just take a quick pause, see if there's any questions here. I'm sitting in the chat, so I'll keep going until Dan tells me not to. Okay, I'm going to be really quick here because I want to get to the other topic, which is the anxiety that I don't want to leave you with too much. I want to leave you with a little message of anxiety and hope today. And just be clear, I'm going to be very narrowly focused on capital markets. There's lots of things to have anxiety about elsewhere, and hopefully some hope, but we'll see. So first thing, manager selection. The long record of outperforming is something. The why should I believe you'll outperform again is also something that's worth talking about for a second. So 4 rules that we follow at our firm when we make advice and give recommendations to Dan and the committee. First is returns are always accompanied by risk. There's not a single investment that we have in this portfolio that does not have risk associated with it. And the way we think about that is not to get rid of risk, because you get rid of risk, you either get rid of returns or you enter in some kind of fraud, because there's no such thing as a return without risk. But the big point for us is to make sure that we understand the risks. We understand the downside scenarios of those risks and we can live with them because sometimes we are going to be wrong. And sometimes you have to live with that downside scenario. So it better be something you can accept. And so that's really, really important. That's what our team spends a lot of time working on and thinking about with our managers and with the portfolio as a whole. Second point, we must understand the strategy, know the key people, and we don't like complexity. And I can torture you for days about what I mean by that, but the long-winded way of saying is you don't own private investments in a public portfolio. You don't use leverage. You don't do all kinds of things that create a gigantic amount of risk that is impossible to underwrite, impossible to understand what the downside scenarios really are, other than complete disaster, which is unacceptable. The point I will make here, though, is that we spend a lot of time getting to know the people who manage money in this portfolio. So we don't manage the money. The managers that are hired in the index funds are where the money is actually allocated to. And so being on the road, spending time with the people who manage the foundation's money is extremely important. I am glad to say that we are finally really, truly back there on the road on a global basis. We were just doing US travel for a while with a little bit of UK and all that testing to come back thing. But now we're going to Asia in a few weeks and really making sure we know what's going on in the portfolio and also getting the perspectives of people in other parts of the world. And then last 2 more questions. I see there's something in the chat. Operational issues. We have a full operation due diligence team. They make sure the auditors are there. They make sure that there's a fund administrator, a custodian. Independence is really important. Protecting the capital here is important. There's no risk. There's no return associated with taking operational risk on. And so that's why we are very focused on that. And last but not least, this is an ongoing forward-looking process. And therein lies the secret sauce, which is that when somebody does really well in a portfolio, human nature teaches us, or human emotion drives us to think that that's a great idea. And when something is struggling in a portfolio, human nature teaches us or drives us to say, oh, that's not a good idea. And all we're doing is reacting to the past. And instead of what we should be doing is thinking about the future. And capital markets are actually so simple on this front, and so is investment performance. It's cyclical. So the minute you feel good about something that's done well, you really should feel the opposite. You should be nervous about it. The thing that's not doing well, again, with a lot of good checking to make sure you know why it's not doing well, to be clear, that's probably what you should be most optimistic about. And by the way, if you want to point to the one thing that has made this portfolio successful, that has made our firm successful over the years, it's that we really practice that craft of understanding why people are doing well or not doing well, and being afraid of the winners and a little bit greedy about the losers, thinking that they're the ones who are going to be our future success. So I do see a question in the chat. Okay, the question, I'll read the question, that's okay. Thank you, Charlie Kirker. The long-term pool has an allocation to tips, but the SR pool does not. Is there a policy reason? And with tips now yielding around 9%, are they unusually attractive? So this is just a downplaying of government bonds and having things that are more socially responsible in the socially responsible pool. So that's the difference, at least historically, that we've had between the two pools on tips. Tips have outperformed, but tips are a risky vehicle as well, and so we're not particularly upset that we don't have them in the socially responsible pool, in the sense that tips have very, very low yields, and they're really a bet on unexpected inflation. So I would argue that tips are probably, not that we're taking them out of the portfolio, they're not short term, as I mentioned, but with inflation running as high as it is right now, it's hard to imagine demand for tips getting any higher than it is right now. So we have to be very careful with them today, is what I would say, because again, they're driven not by the inflation rate per se, or that's the structural point of tips, but they're really driven by market prices and what people think inflation will be. So it's a complicated subject, Charlie, but a really good question. Thank you. So I'm not going to torture you with this. This is the long list of and partial list of the things that we spend our time at Crucial thinking about. We have an investment team of 24 people who this is what they do all day. And I'm chief investment officer, so I also do it with them and also watch what they're doing, of course, very carefully. So now let's switch gears, if we can, to the things that I know keep me up at night. And some of it's excitement. So excited what's going to happen. And some of it is worry. So at the top, you'll see we wrote long-term versus short-term anxiety. And so what do we mean by that? And what we mean by that is that one of the things that we are struggling with right now is that everybody has short-term anxiety. And again, I'm limiting this to capital markets, just to be clear. Why do we have short-term anxiety? We have short-term anxiety because we don't like the fact that our portfolios are sinking in value. And that's very legitimate, of course. Our problem, though, is that we know, and I'm sure everyone on this call does as well, that's going to come and go, though. We're going to have good years, we're going to have bad years. We've all been through this enough times to know that this market will change again, and it'll change in a more positive way. It's just a matter of when and how it will happen, but it will happen. I don't think there's any debate about that. But what we're worried about is there's some things happening right now and have been happening that set up capital markets for very weak long-term returns. And that's the case I want to walk you through today. But I do want to be clear. Capital markets, when I say that, I mean the indexes and the capitalization weighted indexes. The markets themselves have some of the most extraordinary opportunities we've ever seen, actually, as investors, given that the risk of the climate is not as high as we think it's been at other points in time. So here's the first kind of cut at this. So inflation is the thing. And it's the thing not because we all are suffering from its implications in terms of how it affects our purchasing power and our pocketbooks, but it's the big thing because it's leading to, frankly, a long overdue shift in the way central banks are pumping unlimited amounts of money, or we're pumping unlimited amounts of money into the system. The problem is that as this shift occurs, the bubble that was created by central bank policies now has to deflate. And by the way, I'm sorry to say that has not really started in a meaningful way yet. And that's the scary part of this strategy. We'll get to that in a minute. The second point, interest rates are still very low. In fact, they're shockingly low given how high inflation is. We'll talk a little bit about that later. And this is the point I made a minute ago. The indexes, especially the S&P 500 and the All Country World Index, are extremely expensive today. And I'll talk about that a little bit in a second. The third point is I think a lot of people are coming into the investment game and have been in this game, more younger people than some of us probably, but they got here in the during the rise of Bitcoin, and they're guilty, not every one of them, of course, but a lot of people are guilty, and us included at times, of what we call anchoring. And what that means in English is if something traded at $100 a share and now it trades at 20, the anchoring argument is, well, it's down 80%, it's a bargain. Well, that's not exactly right. It could be a bargain, but maybe it's only worth 5. In which case, 75% down 80%, then down another 75% gets you to the bargain price. And so, buying something just because it's down doesn't actually make it wise. It's a hard thing to accept. But again, back to the bubble that we've had in the markets. Bubbles create very, very big risks and very big drawdowns that are necessary to correct for that problem. And the last point, which I'm going to spend a little time at the end, is a lot of people really know a certain thing and they know what's worked for them recently. And so kind of their whole analysis they go through today is, well, I had this stock and it was trading up here. It was a tech stock probably. And now it's way down. So that must be the best place to put my money back because it's down. But what about maybe owning, I don't know, a financial service company, maybe owning some kind of cyclical business, owning a food processor business? You know, there's a million other businesses out there. And the point we're making is that the winners of the last cycle usually are not the winners of the next cycle. And that's I think, the opportunity cost risk that people are taking today as well. Okay. So let's walk you through again a little bit of this negative case, and I apologize, this will not be overly depressing. I hope not, at least I hope it won't be. So this is the don't worry about it graph. So this is basically the S&P 500 from 1928 to 2022. And, it's pretty simple. These are all, mostly, it's not every awful thing that happened along the way, but quite a few of them are listed, as you can see. And what you also can see here is, the point of the graph is simple. It moves up over time. Don't worry about it, right? It's going to be fine. And actually, I think that's fair. And we're not arguing that you should be so worried that the S&P is never going to rise again. I'm definitely not saying that. But look very carefully at the graph at two things. First of all, I don't know if you can see my mouse on the screen, but there's areas around 9/11, huge. This is a very long scale graph, but many, many years, 10 years plus, where the index went nowhere. That happened here in the Vietnam era as well. It happened obviously back at the Great Depression time frame as well. So again, the idea that markets go up over the time periods we expect them to is actually not true. There's no guarantees. So that's one problem. The second problem we have is if you look at the right side of this graph, kind of starting from around QE1, actually starting exactly around QE1, the graph, those little blips, one of them is COVID. I mean, for God's sakes, it's crazy, right? To think about that that's the case. But basically, what you can see is the line has been incredibly stable and upward sloping. And here's the problem. If you look at every other time in history that's happened, it was followed by a period of weakness. Again, back to cyclicality. A lot of future return had just gotten paid to us over the last decade, 2022 notwithstanding. And so the fact is that this graph tells you a picture which you should remember. Think long term, but it also tells you another picture, a thing that you should remember, which is that there's long days in the wilderness or the desert in this case. And so you really need to be sure that you have that in your mind as an expectation. And two, that you do what you can to basically mitigate the risk that you end up with a lot of essentially what we would call dead money, i.e. return assets that don't return anything for a long period of time. So the case for why we might be at the front end of this is twofold. One is what I just showed you, which is, hey, everything's cyclical. This thing has been going up a long time, very, very nicely, by the way. And the other is price and valuation. So I keep alluding to the risk of the index's valuation today. So the way we think about valuation, which is really important, is there's something called a Shiller ratio. So a Shiller ratio, Bob Shiller is a professor at Yale, who came up with this idea that what he was going to do is get rid of the cyclicality of earnings. Because the problem when you're looking at a valuation in the market or a price earnings ratio in the market, you're basically looking at usually the last 12 months earnings and the next 12 months earnings. And that's fine, except it's subject to all kinds of cyclical forces, like it's been a good economy, it's been a good period for this business, maybe on a one-time basis. There's a million things that can skew that number. So Bob's brilliant idea was, hey, let's just take the 10-year inflation-adjusted average of earnings, and then we'll get rid of the cyclicality, and we'll have a really good measure of what the market's priced at on a long-term basis. So second thing you see on this graph. So this goes back to the 1880s. Bob very generously on his website provides all this data. And you can see that the right side of the graph shows you that you can see that plunge, this is through June, down to the red dot. And the problem is that the Shiller ratio right now trading just below 30, it's higher today, it was still 43% above its historical mean. It's also, if you think, still just barely below the levels it hit on Black Tuesday in the 20s. So it's not cheap is the problem. And the reason that you should care about this is quite significant. Shiller ratios have extremely high correlations to the next 10 years returns. By that, I mean 0.7 is the correlation, which if you're a statistical person, you'll know that's extremely high. And what that means is the higher the Shiller ratio, the lower the forward returns. And this Shiller ratio we're at today basically leads to the conclusion that the S&P maybe returns 3.5% to 4.5% per year. If inflation is going to run 2.5, 3.5% per year, which is way below current levels, let's say it settles at a lower level, how are you going to preserve the purchasing power of capital if you're only making 3.5, 4% on the S&P 500? That, by the way, is a nominal return, i.e. before inflation, and it also includes the dividend. So that's the problem here, is that the market is still extremely expensive. Now, the two last thoughts I want to leave you with on this is, first of all, this Shiller ratio stuff, most people could care less about Shiller ratios. And the reason they don't care about them is because they don't tell you anything, literally nothing about what the market will do next year or the year after. So you have to have this 10-year perspective where they tell you literally almost as much as you could possibly hope to know. But the fact is that if you're looking for a year or two, Shiller ratio is completely useless. That's the first point. So don't take this to think, oh my God, the market's going to be down next year. It could be up 50% next year. It doesn't mean that the Shiller ratio is wrong. And the second thing I think is important is that a market, and this is the really key point, that 43% overvaluation, we'll call it here, doesn't need to correct through a crash. It could actually much more likely correct through a period of malaise. And so going back, these long periods where the market went nowhere is the way the Shiller ratio most likely gets addressed. And that's still bad. And the problem I have with is that it's predictable. What we know what the Shiller ratio is, we know what it means for long-term returns. And so sitting back and accepting a decade of subpar returns feels very, very off to me. Question did come in the chat, a good one. Sorry about that. What is QE1 and QE2? Thank you, I'm sorry. So quantitative easing is what that refers to. So this is the Federal Reserve policies and the Bank of England and the ECB and the Bank of Japan. They've all been an attempt to stimulate economic conditions since the great financial crisis. They have been buying bonds to artificially depress interest rates and flooding the system with money. And that's what QE is, quantitative easing. It's a kind of a technical term, but just think of it as pumping the system filled with cash and hoping it didn't have any negative implications, which it hasn't for the most part, except it really didn't really work that well in the economy. And it did create this asset bubble, which is why the S&P is so expensive today, is because of, we would argue, quantitative easing made a big contribution to that. Okay, so let's get to a little bit of a happier thought. So the index does not look appealing. Again, there are no guarantees we're right about that, but history is really, really clear, as is logic. And I will tell you this, I hope for your portfolios, and I know for the Vermont Community Foundation pools, we are just not willing to say, well, maybe this time will be different. And this time will be the one time in history that Shiller ratio doesn't matter. That does not feel prudent to me. We need to be respectful of the fact that logic does matter, and markets do eventually find their way to something logical, although they spend very little time there ultimately. But this graph gives you a sense of why, when I said before, it's the index has to be kept and thought of distinctly from the markets. Now, this is, by the way, let me be really clear, this is not an index fund tirade you're about to hear. In fact, there are great indexes like the value indexes, for example, in this case, that are very interesting. The problem is the indexes people want to own today are not those indexes for the most part. They want to own the ones that have done well. And that's where the risk exists for them. Again, not tomorrow and not next week, not next year even, but 10 years from now, they wake up and their money just didn't generate the returns it should have. So what this graph is looking at is kind of a crude way of getting to, a very rough way of getting to the idea of securities very differently from 3,000 growth index. So let me just step back for 1 second. Growth index funds like these are what we call capitalization weighted, which in English means that the size of a company, the number of stock shares it has outstanding times the price, dictates its weight in the index. So for example, Apple is the world's biggest company. Last time I looked, I didn't look today, it's had about a $2.7 trillion market capitalization. It is a very big part of the S&P 500. Last time I looked, it was almost 7% of the index. It's even a bigger part of this Russell 3000 growth index. So the reason why we look at this graph is the blue line, again, is the top 10 names. So one of them would be Apple, of course, in the Russell 3000 growth. Another would be Microsoft. Another would be Tesla, NVIDIA, Amazon. I can go on and on and on down the line of names of stocks that are very, very popular stocks that have done very well for their investors, by the way, looking backwards. So here's the problem. Take a look at that blue line. Back to 1990, those top 10 names, which were different names, but they were still the biggest companies in the world, and the US market, at least at the time, 25, 30, 35, 40% of the index in those top 10 names. Look at it today, and I think today is the end of June, by the way, in the neighborhood of 70% of the index in just 10 names. So that's the growth index, to be clear. So that's the To us, that's the definition of risk. And there's an old expression which I love, which is risk is greatest when agreement is greatest. That is exactly what this looks like. Everybody is quite confident in the future fortunes of these companies. And part of my retort would be two things. One would be to say, yeah, people said the same thing about Cisco, IBM, General Electric, Kodak. I can go a whole long list of companies that were always going to be dominant forever and just a different era. And I'm sorry to say, for those who love Amazon and Apple, this time will be no different. They will suffer the same fate. It always happens. Innovation has not died. The world will change again. It always does. It'll just take time. The red line is the value index. And the reason we show it is it's kind of boring, as you can see. But more importantly, look at the gap. That gap is really important. That tells you that the rest of at least the value index, and I can assure you the rest of the market, there are a lot of companies out there that have not gotten crazy expensive, even though the index and those growth stocks have. And that's why this graph is so important. It just gives you a really clear picture of why things are very different right now. And then one more thing on this subject, and then we'll move on. The other question I hate, so don't ask it, is, when people say, yeah, but you know what, your Apple argument, for example, I'll pick on that one, no one actually says it this way, but your Apple argument, maybe that was true in the past, but this is different. We're in a different world. Everything's different now. Technology is so powerful, it's not going to change. And your arguments about the past and your Shiller ratios and your valuations, all that crap, they're being sarcastic when I say that, I hope, are just not going to work anymore. And my retort to that is, yes, the world is always different. It was different across that entire long S&P period you saw. Life changed dramatically around time. I'm not sure it's actually changing that much more dramatically today than in the past. I can't really put that into perspective personally. But what I would say is this: there's one thing that never changes, and this is very important to our strategy. And that never thing is human nature. Human nature is the same. And this graph is an amazing picture. Sorry, I get really excited about stuff like this. I'll try to contain myself. This graph is an amazing picture of human nature. So let me explain what you're looking at. These two lines, the red line is something called the triple Q. So that was it's also known as the NASDAQ 100, which is those big dominant growth stocks I showed you a minute ago. I mentioned some of their names a minute ago. This is, by the way, back in 1999. So that first, it's a little hard to read, I apologize. But September 99 is the first horizontal label at the bottom there. And then the blue line is the ARK funds. So ARK is Kathy Wood's ETFs that are innovation funds, essentially. And I want to be clear, we're not picking on Kathy specifically, her, the ARK funds. We only use them, or this group that we pay for research uses them, because it's an ETF. So it's really a really neat way to just look day to day at performance. There are plenty of other investors that have invested in innovation and have either done better or worse, in a lot of cases, even worse. But here's what's so important about this picture. This is essentially the blue line, again, is August 2020 to today, which is why it doesn't go as far as the red line. The red line is 1999 to 2002, where the index essentially bottomed at that point. And this is, let me be clear, I said I was a master's degree in statistics, so be careful with statistics, people, because we do all kinds of stuff that can be hopefully never intentionally misleading, but can be a little misleading, like use what we call dual scale graphs, where you make two things look the same by using different scales for the different pieces. This is not a dual scale graph. This is a single scale graph. Watch how the two lines on the left side of the screen go up literally on top of each other. And it's the same scale at the bottom too. Every point is 3 months. So it took almost exactly the same amount of time for these two bubbles to kind of inflate. They did so to almost the exact same magnitude. And now watch as they come crashing down. It's not exactly the same, but man, is it close. And this, to me, is a beautiful picture of human nature. People get very excited and a little greedy maybe, and they just love the good days. And then the bad days start. And it takes a long time for that to all figure out. You have to wash people out, essentially. It's a horrible thought, because that means people lose a lot of money, and I feel terrible about that. But that's the process. And so this graph, I'll make a big deal about it, because all we're doing at the Vermont Community Foundation and the investment portfolios is taking the other side of human nature. So that means when things get too expensive and the optimism is too high, we don't want to own that stuff. When things get really cheap and people get really pessimistic about the future, that's what you want to own, again, with a very good underwriting process for the actual companies that we're talking about here. So it's not a just throw stuff at the wall and see what happens strategy. So two more quick things, and I'll wrap this up and see if there's other questions you have. The first thing is, when you think about your funds, and this is a question we get asked a lot, which is, how do we think about timing of either, adding, withdrawing, however we're thinking about our funds, the community foundation, how we think about our personal portfolios. And I would say this, there are three things to remember. The first is don't fall into that trap of, oh, is this the bottom? When's the bottom? Market's up now. Maybe it's going to stay up. Maybe it's going to go down. Nobody really knows. And there are so many people out there, to me, playing lottery tickets, making guesses, hoping they're right, and maybe getting famous because of it. But this is your money we're talking about, or your charitable money or your personal money. Don't get caught in that game. No one has any idea what the market's going to do. And when I read a sentence that says, I think stock XYZ is going to be up in the next 6 months, I immediately turn to the next page, because whoever wrote that is got some agenda that I don't understand, because there's no way to know that. The second point is what you should be worried about all the time is if there's a mismatch between your investments and the risk that you're willing to take. So for example, when you hear someone say, you know what, I'm going to buy a car in 2 years, I'm going to put my money in the stock market, I'm horrified by that thought, because it's pure luck whether or not that's going to work out for you or not. If you need more money to buy the car, then maybe take longer to buy it, find a safe investment that will help you get there. I don't know how to answer the question from that perspective, but the reality is that when you have a mismatch between your time horizon and your investments, you are asking for trouble. And that's why the Vermont Community Foundation has the 3 pools, two long-term and 1 medium-term, because we are trying to address the time horizon question, because that is a predictable problem that we must avoid. And last but not least, I will say this on the timing question. So again, no clue what the next 6 months look like, even the next 24 months. But I will say this, when we look at what the Vermont Community Foundation pools, both of them, the midterm pools mostly an index fund, so a little different. But when we look at the 2 long-term pools and what they own, it's hard for us not to be pretty excited. We see huge expected returns from a lot of the equities in there. And it's frankly, if you go through the details, the stuff that's hurting us most is what we're most excited about and hurting us most right now. So the prospective pool returns are actually for both pools very high. And of course, we're always looking to make the pools better. And that's why the investment committee meets at least 4 times a year. So here's our strategy going forward. Very simple. 1, stick to the strategy of relying on decisions with a high probability of success. We didn't stop doing that in the last 3 and 5 years for the long-term pool. We've been doing the exact same thing we've always been doing. We're not happy, and I'm sure you're not, with some of the disappointing shortfalls. But I will say this, those are easily recovered. And we are I'm looking forward to the quarterly public call where I can say, well, here we go. We got it. We got the payoff we've been waiting for. Hopefully it won't be too much longer. Second point, these big pools are really important, as is having a sophisticated investment committee to make sure that we're doing the right things. The conversations that we have with them are enormously interesting and valuable. But you can see scale, stability, and being long-term are a big deal. As I mentioned earlier, index funds are a wonderful thing. We just be very careful about the S&P today and the ACWI index. And then last but not least, and I see there's a chat question. I see Dan's got his hand up too there. Over long periods of time, volatility is our friend, which is why my wife always tells me not to act too gleeful when markets are dropping, because it's insensitive and inhumane, I guess is the other word people use. But the fact is that this is a very interesting time to be an investor, and the panic going on out there in certain sectors right now is sad and unfortunate, but we didn't obviously make it happen. So we are, though, willing to try to actually generate higher returns for the Vermont Community Foundation as a result of something which we, of course, did not cause nor wish for. So let me stop there. Dan, were you going to bring this chat question up, or do you want me to take it?
Mike, I was just drawing your attention to the chat question in the chat. So.
Okay, given the valuation difference between growth and value, if you're an ESG investor, how do you navigate this when so many of the value stocks are distasteful? Oh, that's such a great question, William. It's a tough one. It's a really tough one. But let me give you an example in the Community Foundation portfolio. So what William's saying is exactly right, just to level set for everybody. A lot of ESG and value heavily tilted towards the growthier sectors, technology and healthcare, largely because of the values issue, that it's just much easier to find companies that do not violate your principles in that part of the world, as opposed to, for example, owning coal stocks. So it's tough. And the answer is that you have to kind of accept some degree of that. But with that said, I'll give you 2 things that I think are important. One is, if you are using active managers who are more growth oriented, the points I made earlier about high prospective returns don't just apply to value stocks. There have been some incredible bargains created in smaller and mid-cap growth names in healthcare and tech these days. So I would frankly be focused on that a little bit as a way to overcome some of the problem that I was addressing before, which was really, by the way, and I didn't really say this, very much a very much a large cap growth problem, not a small cap growth problem. I think it's really important to distinguish those darlings I mentioned earlier are just big companies that are extremely optimistically priced. Now, the second thing, this is a little more nuanced, but the foundation has an investment in a manager on the West Coast named Redwood Grove. And Redwood Grove is extremely focused on climate, and they are a value manager. And what's kind of their secret sauce and what they do is, first of all, they will not own an extractive fossil fuel company under any conditions, period, full stop. But on top of that, they're very focused on which companies in America are driving towards positive change. And we mean real positive change, not the crazy corporate BS statements that people make sometimes. And they, frankly, one of the ways they do that, which is really interesting, is they focused on which companies are actually accounting for the cost of carbon in their business plans to make more rational decisions about how the planet and the changes in the planet are going to actually affect their businesses, which, by the way, at the end of the day, values investing is one thing. ESG overlaps with that, but adds in this concept of accounting for the costs of the changes going on to our climate and to our planet as real business risks, because that's what they are. So there are value strategies, but I will tell you, you have to be willing to do what they're doing, and which is to say, this company may not be exactly where we want it to be today, but we think we're heading in the right direction, and they're doing real things that are going to get them there. And that can lead you into some value names, just to be clear, which sometimes they're semiconductor businesses. There are other companies that are more obvious that might be funding solar and other types of solutions to the climate issues that we're suffering from fossil fuels. But the other thing which does get into the equation, we're not doing this in the portfolio presently, and we may not. There's also a case that some would make, so I'll just throw it out there in the interest of completeness, for corporate activism as being a way to be ESG oriented if you're with the right people who are truly trying to do something important. And they use the obvious or recent example of this. There's a company also happens to be in San Francisco named Engine Number One. They're the ones who took 3 board seats at ExxonMobil last year, if you remember, in a very big proxy fight. They are a value-oriented manager who owned a lot of Exxon stock, which means you have to own Exxon stock, but they did it because they thought they could help get this company to be more responsible, which is debatable whether that's happening or not. But with that said, there are ways to get value investing into the equation as an SRI or ESG investor, but you do have to kind of look at things as what's the potential here as opposed to the current reality. So that's the catch. And if you're not willing to do that, it does get a little tougher, just to be clear.
So there's another question, Mike, from Nancy Anderson around whether newer VCF fund holders who haven't participated in the growth curve over the last 10 years, changing their distribution of your scope, although you may have some observations about liquidity that are interesting relative to grant making in a down market. To Nancy, to answer your question, as a reminder, we calculate our advised spendable for fund holders based on a 12-quarter rolling average. So we smooth some of the volatility in terms of when we're calculating the spendable that we encourage you to grant make with. That said, we always anticipate people will do more grant making than even the spendable amounts are likely to cover. So we have enough liquidity that we can adapt. We haven't seen people really curtailing their grant making in the last couple of years. I think in large part because of the social urgencies that we see. And in fact, when the market was down in the first couple of months of the pandemic by 20 to 30 points, we saw people accelerating grant making and giving a dollar that was actually worth $1.30 3 months before. And so I think that speaks really to the generosity of the incumbent fund holder base. So whether or not it's a good strategy really depends on the philanthropic objectives of a fund holder and family, over time. And I trust you to pick it up in a conversation with your philanthropic advisor to navigate what your objectives are and how to address that. We have, one of the core challenges that Mike has been really effective, and the team at Crucial have been really effective at managing around just ensuring that we have adequate liquidity for when that inspiring project comes along and somebody wants to make a gift that is ahead of what the spendable amount might be, based on the kind and nature of the project as it comes up. So I hope that answered your question, Nancy. Thanks. Let's see. from Greg Hopper. I'm going to let you answer Greg's question. The first is an example of which something which is hurting right now, but for which you have high expectations. And the second is around valuation issues in the market. Are you using any managers who are shorting equities or whole sectors? I'll let you answer that, Mike, but I think I know the answer.
Yeah, you do, Dan. Got it. An example. I'm glad I had a chance to think about that because there's so many. I'll give you two real quickly. One is we have a life sciences manager in the portfolio that had been really struggling until very recently with some of these big biotech names like Seagen, for example, which, by the way, they would have described as the cheapest, safest big biotech company they've ever seen in their careers. That's turned around a lot because there's rumors that Merck's going to buy them, which, by the way, is just to get on a very quick tangent. That's what worries us, actually, is that corporations and private equity investors are going to come in and steal really cheap public companies from us that we've been waiting for them to come back. So we're very focused on how our managers can stop that. In the case of Seagen, the owner that we have in this portfolio is extremely aggressive at looking after their shareholders and very powerful firms. So we're hoping they're going to make sure either it doesn't happen at all, this purchase, or the price is very high, one or the other. Second example, real quickly, we have another manager portfolio struggling called Fpr Partners. And they own a lot of things like cable businesses, and they own insurance companies like Arch Capital. And their portfolio has really struggled. But the weird thing is, if you look at the performances of the businesses and the stock prices, it's hard to reconcile them. And I'll give you, for those you don't think about this stuff all day, this portfolio has what we call a free cash flow yield, which means after the profits these businesses earn, after whatever you need to continue to grow the business. So you take out, cash that you need to invest in capital expenditures, et cetera. The free cash flow yield on their portfolio is 12% as of June 30th. And their earnings and cash flows are growing at 15% plus per year across this portfolio. And so that's just a great example of something like, wow, how do we not generate huge returns on that over the next 3 to 5 years? It's almost impossible to imagine. And then the last part of this question was, given valuation issues, are you using managers who focus on shorting equities? Yeah, we do have some hedge funds left. In a tough place to invest is probably a great example of cyclicality. And we do like the shorting environment. Although I have to tell you, people, because of the dominance of these large names that have kind of really been tough to be short, and to the meme stock craze has really made it hard to be a short seller these days. You just don't know when GameStop's going up 250% for no reason. So with all that said, it's brutal. So we have a little bit. It's not going to be it's not going to be a huge difference maker in the portfolio, to be clear.
There's one more question right after that from Tom Roberts. Thank you, Tom. Mike, can you summarize why the VCF pools are underperforming the benchmark this quarter?
Yeah. Very simple answer. It's growth exposure. So what's happened is as the question earlier said, the SR pool has more growth exposure, which is why it underperformed by more. But basically exposure to anything on the growthier side, especially small and mid cap stuff. But even the large cap names had a little bit of a comeuppance in the second quarter, which has sort of changed now in the third. So it's really simply put growth exposure. And I will add, last thing, because really important, we make a distinction between fundamental drivers of businesses and market price. And in the case of the exposures and the underperformance, this is really not about fundamental drivers. These are not deteriorating businesses. We don't own something that's about to go bankrupt, for example, or about to be a gigantic disaster. The markets don't like stuff that's growthy, and they don't like stuff that's growthy because interest rates are rising and people are starting to think about the cost of capital differently, which is fine. But babies, and that old expression, babies getting thrown out with bathwater, that's definitely what's happening, at least in some parts of the portfolios. And that's why we're optimistic that can't last forever. It has to change. It always does.
Well, thanks, Mike. You've given us a lot to think about and a lot of information about 95% of our holdings. For those of you on the call, you'll know what I'm talking about. And if you go back to slide 6, you'll see that at the bottom of that asset allocation stack that Mike reviewed with us, there's a 5% allocation for each of our pools. And that is to our Vermont pool. That is Vermont investment that we are doing directly in our communities here in Vermont. And the foundation, Vermont Community Foundation, is unusual, if not unique, in our commitment to making investments in our own communities. If you take a peek at our business plan that you can see on our website, you'll see that that commitment is a big piece going forward of our plan to invest with our neighbors to grow our communities locally. So not to steal any thunder from the 95% piece of the portfolio that Mike has been managing so adeptly, but we also want our investors to be aware of our 5% Vermont Pool too. So, and I don't know if Dan just shut his door. You saw him coming out there because I think there's some feedback.
I shut my door because I was getting a reverb from Nancy.
Yeah,
So
a little bit of that happening. And Dan, I don't know if you want to. I know we're running out of time. Take a moment to talk a little bit about the Vermont Pool.
Sure. As Nancy articulated, we see it as a key piece of our growth, both in terms of our community impact, but also in terms of, an increasing number of fund holders who are interested in making a difference, not just with grant making, but with the ways in which their funds can be actively invested in communities. Funds invested in Vermont tend to be somewhat less liquid, so it defers a little bit of impact, but you get to drive around or be in your community and look at the change that is driven, whether it's affordable housing, downtown revitalization, job creation, Mamava working fields, high mowing seeds, and then Wolcott. Projects like that, People Square in St. Johnsbury, the Putnam Walk in Bennington, Riverbend on the just south of Morrisville, new affordable housing project with VHFA. There's things that are going on that fund holders in the VCF are actively invested in, and sometimes that are driving a difference that we want to see in Vermont communities. And it is we are different as a community foundation because we populated it with an asset allocation as opposed to raising funds directly into an impact investment. Although we have seen in the last couple of years the addition of funds specifically for that purpose to the VCF allocated to the Vermont portfolio. It's an exciting piece of work and an important one and emergent one in the field of community foundations and community philanthropy. If there aren't more questions, just a final call. Looking around, everybody's got their cameras off, so I can't gauge faces. I'm just but I do appreciate everybody taking the time to participate, sharing their thoughts, questions. It's always good to see everybody. If you have any questions in the interim, don't hesitate to reach out to Nancy or I, and we can endeavor to answer them, or reach out through your philanthropic advisor and the Stacy Fagan and her team at the VCF. Let us know what you're seeing, what you're inspired by, or what you're worried about. Look forward to making a difference in Vermont in the months ahead. Thank you very much.